The goal of this course is to teach you bookkeeping both quickly and effectively. By the end of it, you'll be able to confidently do the bookkeeping in your business, have a professional understanding of bookkeeping, and with that professional understanding, be able to breeze through most, if not all, bookkeeping certification programs, if that's what you want to do. This course is designed for small business owners, but if you don't own a small business and you just want to learn, you're in the right place as well. So with all that said, welcome to Bookkeeping for Small Business Owners, a crash course in bookkeeping. As a quick introduction, my name is Christian. I'm the owner and chief bookkeeper of Vitality Bookkeeping. I have 2 accounting degrees. I'm certified with Intuit as a trained bookkeeper and a QuickBooks Online Pro Advisor, and I'm actively working with a number of clients as their bookkeeper. If you want my full backstory and credentials, you can find them on my website, vitalitybookkeeping.net. Likewise, if you want your books taken care of, I'd be happy to do them for you so you can focus on the real work in your business. Once again, if you're interested, go to vitalitybookkeeping.net. All right. This course is going to be structured like a pyramid, where we'll start at the very bottom with the fundamentals and then build our way up until you have a complete understanding of bookkeeping. I'll be doing this in a way that's very simplified and practical, as opposed to the long technical descriptions. I'm going to make it so that it's going to be simple and easy to understand. And likewise, I'm going to be using a lot of real-world examples so you can apply the lessons as you learn them. And most notably, though, repetition is a very effective way of learning, so I'm going to be using a lot of repetition as well. And one more thing while we're at it. This course will be focused on cash basis accounting. Don't worry if you don't know what that is yet. We'll definitely get into that later. For now, just know that cash basis accounting is the most common method of bookkeeping and is used by close to 80% of small businesses. It's overwhelmingly likely that you're using cash basis. But if you want to double check, go to your tax return and near the top, it'll say the words cash or accrual, one of those two. You'll learn a lot from this course either way, but it is focused on cash basis. And if you are accrual, you'll still learn, but be sure to brush up on the differences. All right, with all of that said, today we'll be starting at the very bottom of the pyramid, answering the questions, what is bookkeeping? What does a bookkeeper do? And then, why do businesses even need bookkeeping to begin with? After that, we will go into some of the more boring sounding items, those being the 4 ethics of bookkeeping and the 10 accounting principles. And although they do sound boring, they are very important, and they form the foundation for all the bookkeeping you'll be doing in the future. That said, though, don't worry. You don't need to learn them all at once. I just want you to become familiar with them, and I want you to use either this video or your own notes as a sort of reference for them in the future. So let's get started with today's lesson. What is bookkeeping? Well, lucky for us, bookkeeping describes itself. Simply put, bookkeeping is keeping the books. The books, which is something we'll touch on later, are used to organize all of the transactions in a business. A much easier definition, though, and the one I actually want you to learn, is this. Bookkeeping is keeping track of how money flows through a business. It's keeping track of when money comes into your business, when you receive cash from things like performing a service or selling inventory. It's keeping track of when money goes out of your business through things like buying supplies or paying off loans. It's also keeping track of when money moves within your business, such as when you transfer money between your checking and savings accounts. In short, bookkeeping is making sure every penny in a business is accounted for. Or, once again, it's keeping track of how money flows through a business. If you want a practical description, bookkeeping is looking at the transactions a business has for a given period of time and then properly recording those transactions so they can be used to create valuable information. We'll cover all of that throughout the course, but for now, I just want you to remember that bookkeeping is keeping track of how money flows through a business. This, of course, brings up the question, how is bookkeeping different from accounting? Technically speaking, bookkeeping is actually one part of accounting. We'll cover this more in a later video, but for now you can think of it like this. Bookkeeping is writing things down, and accounting is analyzing what's been written down. This leads to the next question then. What does a bookkeeper do? As you might imagine, a bookkeeper is the person who keeps track of how money flows through a business. More specifically, they do this by going through what I call the bookkeeping cycle. Don't worry if none of the following makes sense right now. I'll cover it properly in the future, but the idea is this. Bookkeeping cycle is an unofficial term to describe the bookkeeping part of the accounting cycle. The bookkeeping cycle typically happens on a monthly basis and goes as follows. And once again, if none of this makes sense, we'll be going over it. I just want to introduce it. All right. It goes as follows. Step 1, you categorize every transaction. Step 2, you reconcile every account. And then step 3, you create the financial statements. The bookkeeping cycle is done on a monthly basis, but it's also done on a quarterly and yearly basis as well, particularly for tax purposes. So, what does a bookkeeper do? A bookkeeper keeps track of how money flows through a business by following the bookkeeping cycle. which of course is something we'll talk about later. Now, why do businesses need bookkeeping? There are plenty of high value reasons to do bookkeeping, of course, including things like knowing your cash flow, knowing what's profitable, knowing what isn't profitable, getting access to loans, making decisions, and so forth. The most important reason, though, is legal compliance. Businesses need accurate books in order to pay taxes properly and to show that they're complying with regulations. So why does a business need bookkeeping? Legal compliance. All that said, let's use an analogy to put everything together. Imagine your business as a warehouse, and every dollar in your business as a package. Every time a package enters the warehouse, a worker scans the package and records the information. Likewise, every time a package leaves the warehouse, a worker scans it and gathers the information. This makes it so that despite a seemingly endless number of packages, everything is organized and up to date. The owner of the warehouse is able to stay legally compliant while having all the information they need to make important decisions. This is the essence of bookkeeping. However, instead of scanning packages as they enter and leave a warehouse, a bookkeeper organizes money as it travels through the business. So, let's do a quick recap. I encourage you to pause and answer before I do. And don't worry about wording this perfectly, just make sure you know the core idea. So first, what is bookkeeping? Bookkeeping is keeping track of how money flows through a business. Second, what does a bookkeeper do? Bookkeepers keep track of how money flows through a business by following the bookkeeping cycle. And then third, why do businesses need bookkeeping? Businesses need bookkeeping to be compliant with the law. Now, let's round out the foundations of bookkeeping by going over bookkeeping ethics and the principles of accounting. And just real quick, if there are any terms that don't make sense, for example, the word financial statements, I don't expect you to know what financial statements are yet. If there are any terms you don't understand, just know that I'm very likely going to cover them in the future, and for now, they should make sense in the context they're in. So let's start with the ethics of bookkeeping. The ethics of bookkeeping can be summarized into 4 core points, and as a total, they are the moral guidelines that all bookkeepers need to follow. In no particular order, these are ethic number 1, honesty. Bookkeepers must always be honest in their work. This one's pretty straightforward, but it means things like reporting numbers correctly, not concealing information, and owning up to any mistakes. For example, let's say you accidentally turned a $10 transaction into a $100 transaction. Honesty would be seeing, whoops, I accidentally added a 0, and then removing the 0 and correcting your mistake. Ethic number 2, objectivity. Objectivity means not letting feelings or any kind of outside influence affect your bookkeeping. In other words, things like avoiding conflict of interest, never twisting the numbers, never mixing business transactions with personal transactions, and of course, always complying with the accounting principles, which we'll learn in a minute. An example of objectivity would be having the opportunity to tweak a number to get a loan and deciding, nope, I'm going to stay objective and I'm going to leave the numbers the way they are. Ethic number 3, confidentiality. Confidentiality simply means keeping private information private. As you know, financial information is very sensitive, and so a bookkeeper must keep that information under wraps. As a business owner, you have more leeway as to what you want to share and what you don't want to share, but generally the principle is this. You never talk about your client outside of the job, and you never use a client's information for personal gain. For example, if you work with a local business and someone walks in and asks, hey, how much are you guys spending between each other? Confidentiality would be declining to answer that question. Ethic number 4, professionalism. Bookkeepers must always act professionally. That means being respectful to those you work with and being able to actually do the job that you were hired for or you're charged with. Studying this course is an example of professionalism because you're doing what you need to do to keep your business operational. And in this case, that's gaining a strong understanding of bookkeeping. And with that said, those are the 4 core ethics of bookkeeping. It went pretty fast because it's pretty straightforward. So let's just do a quick quiz to recap and make sure we're all on the same page. And once again, I encourage you to pause and try to answer the question yourself before I give the answer. So, what are the 4 ethics of bookkeeping, and what does each one mean? Ethic number 1 is honesty. Honesty means always be honest. Ethic number 2 is objectivity. Objectivity means don't let emotions or outside forces influence your bookkeeping. Ethic number 3 is confidentiality. Confidentiality means keeping private information private. And ethic number 4, professionalism, means always act professionally. Once again, there's no particular order here, and in all likelihood, you've probably already been living by these ethics your entire life to begin with. But nonetheless, it's important to go over them just to give you a comprehensive understanding of what's required for bookkeeping. Now, let's wrap up today's foundational episode with the 10 principles of accounting. First, the whole reason accounting principles exist is so that businesses have a standardized way to report their financial information. In essence, these principles translate any business into a universally understandable language. More relevant to this course, though, bookkeeping must obey these principles or be considered invalid. Don't worry though, most of these are common sense and things you would already be doing naturally as a business owner. As mentioned before, these are for cash basis. Accrual basis accounting has a few more, which we won't cover here for the sake of relevancy. Also, there's no particular order, and I don't expect you, once again, to learn them all this episode. I just want you to become familiar with them and to become aware of them. Principle number 1 is the economic entity assumption. This means that, for accounting purposes, a business is considered its own separate entity, different from its owner or any other business. In other words, money that's in the business belongs to the business and not the owner. A business is its own thing. Practically speaking, this means keeping your personal finances separate from your business finances. For example, if you buy groceries with your business card, which you shouldn't do, that wouldn't be considered a business expense. It would be considered a withdrawal from your business for a personal expense. This principle is important because if the business wasn't its own separate entity, there would be no way of figuring out what financial condition the business is in. Everything from taxes to decision making would be completely thrown off. As an example of this principle, let's assume Abby owns Abby's Bakery. If Abby buys several pounds of cookie dough to make cookies to sell, the money she spent on the cookie dough would come from the business, and the money she earns from the cookie dough would go back to the business, not to her. That separation is the economic entity assumption in a nutshell. You quite literally assume a business is its own economic entity. Principle number 2, the reliability principle. Transactions need evidence. Simply put, you need proof before you can record a transaction. As we know from earlier, bookkeeping is keeping track of how money flows through a business. We'll dive deeper into this later, but for now, you need to know that the way bookkeepers track this flow is by recording transactions. The reliability principle states that the only transactions you're allowed to record are transactions that can be proven with evidence. That means you need a receipt, a bank entry, really any type of documentation. If there's no documentation, though, it can't be recorded. For example, if you pay someone in cash for their old office supplies and they don't give you a receipt, then you can't record that transaction and you can't write it off. This is important because if evidence wasn't required, then anybody could make up anything they wanted about their business, which would lead to some inaccuracies to say the least. For another example, let's say Abby from earlier wants to record one of her expenses. She thinks it was $45, but she threw away the receipt and doesn't have any other sort of documentation. Unfortunately, Abby would not be able to record this as an expense. To obey the reliability principle, transactions must have evidence. Principle number 3, the materiality principle. The materiality principle states, details that are too small to affect financial statements can be ignored. For example, if your business makes $100,000 in a year, then you can round up all pennies to the nearest dollar. This principle is extremely subjective though, and honestly, if you're doing your own bookkeeping, I recommend making sure everything is penny for penny accurate. That, or at least consult a CPA before determining what's material and what isn't. That said, the materiality principle is important because by being able to ignore immaterial amounts, accountants and bookkeepers are able to collectively save countless hours of time. Principle number 4, the full disclosure principle. The full disclosure principle states that if there's information about your business that will materially affect the financial statements, that information must be reported in what's called the notes to the financial statements. For example, if an employee sues a business for $1 million, but the case hasn't gone to court yet, that pending lawsuit needs to be noted with the financial statements. The full disclosure principle is important because not everything that affects the health of a business will be in the numbers themselves, and the people looking at the financial statements need to know what condition the business is in. Principle number 5, the conservatism principle. The conservatism principle states that if you're not sure, choose the least optimistic option. In other words, always err on the side of caution. For example, if we look at the lawsuit from the full disclosure principle example, after we've disclosed the lawsuit, if the business is likely to lose and that loss amount can be calculated, the conservatism principle states that the least optimistic of these equally likely outcomes should be recorded. Vice versa, if the business is suing somebody for a gain, they cannot record that gain until victory is either certain or it's already won, such as after a court order. In other words, you record likely losses, but you don't record likely gains. The conservatism principle is important because, by erring on the side of caution, it creates a much more honest and reliable picture of what state the business is in. Principle number 6, the consistency principle. The consistency principle states that once you start using an accounting method, you need to stick with that method. It's acceptable to switch methods only when that switch is both well documented and would improve your financial statements. I mentioned cash basis accounting near the beginning of the video. The consistency principle states that if you use cash basis accounting, you need to record everything under cash basis. That is, of course, unless you decide to switch to accrual, which would need to be well documented and also be an improvement. For example, if Abby does her bookkeeping under cash basis, she can't start suddenly doing it under accrual basis partway through the year. She would need to consult her CPA and go through the correct process. The consistency principle is important because it allows a business to compare itself over time. If accounting is done one way in one period and a different way in the next period, it can be challenging to understand how the business has changed and may lead to material problems. Principle number 7, the going concern principle. The going concern principle means that you should always assume a business will stay open unless there's significant evidence otherwise. This means recording transactions over their appropriate time period unless the business starts feeling shaky. For example, let's say Abby buys a new oven for her bakery. She would record the transaction under the assumption it will be used for her business for the foreseeable future. If auditors or management note that a business is on shaky footing, then they will have that note in the financial statements, and if a breaking point is reached and it's time to go out of business, the business will shift from going concern to liquidation. The going concern principle is important because it ensures financial reporting matches the economic reality of the business, which is that businesses expect to exist for the foreseeable future. And one last thing, foreseeable future means a 12-month period, typically speaking. Principle number 8, the monetary unit assumption. The monetary unit assumption states that all financial reports must be done with a single, stable currency. For example, in the United States, financial reports must be done with the US dollar. If a US business wants to track their books with a separate currency, that's fine, but they must convert those amounts back to the US dollar for official submission in the United States. Also, most currencies, including the US dollar, experience inflation. For the sake of consistency, the principle requires that we ignore inflation in the United States, except for cases of hyperinflation, which will be made obvious. The monetary unit assumption is important because by using a single currency, financial statements become simple to create and understand. Likewise, using one currency ensures everyone reads and understands the financial information in the same way. Principle number 9, the cost principle. The cost principle states that assets should be recorded at the amount you paid for them, without ever adjusting for market value. In other words, when your business buys something, the cost of that thing becomes the official value in the books, even if the market value changes. For example, if you pay $200,000 for a building and the market value is $250,000, you would still record the building as being worth $200,000 in your bookkeeping. The cost principle is important because it keeps things objective. Market values change all the time and can be highly subjective. By sticking to the original cost, your books are based on actual, verifiable transactions. Principle number 10, the time period principle. The time period principle states that a business's financial activities can and should be reported in shorter chunks of time, such as monthly, quarterly, and annually. For example, if you heard a business earned $100,000 over a 2-year period, it would be useful, but a lot of context is missing. The time period principle makes it so you can break down those earnings into smaller windows of time to get a better idea of what actually happened, such as what happened in what quarter. This principle is important because it allows those interested in a business, such as debt holders and investors, to clearly understand how the business operates over time. And that's it. Those are the 10 principles of accounting. It was a lot to cover at once, and we happened to do it all very quickly. So it's totally normal if you don't understand everything yet. The main point, like I said, was to get yourself familiar with these things so that we can get started on the real bookkeeping next episode. For now, let's do a quick recap quiz to make sure we're on the same page. Once again, I encourage you to pause and try to answer before I do. And don't worry if you don't get the words exactly right, just try to recall the essence of what we went over. Also, since it was a lot at once, and we're not going to spend a lot of time on these, for this quiz, I will give you the name of the principle, and I just want you to try and remember the definition. All right, let's get started. Number 1, what is the economic entity assumption? For accounting purposes, businesses are considered their own separate entity. Number 2, what is the reliability principle? Reliability principle states that transactions need evidence. Number 3, what is the materiality principle? Details that are too small to affect the financial statements can be ignored. Number 4. What is the full disclosure principle? Material financial information must be disclosed. Number 5. What is the conservatism principle? If you're not sure, choose the least optimistic option, or err on the side of caution. Number 6. What is the consistency principle? Once you choose a method, stick with it. Number 7. What is the going concern principle? Assume a business will stay open unless there's significant evidence otherwise. Number 8. What is the monetary unit assumption? All financial reports must be done with a single stable currency. Number 9. What is the cost principle? You must record assets at the amount they were paid for. And number 10. What is the time period principle? A business's financial activities can and should be reported in shorter chunks of time. All right, that was the first episode of Bookkeeping for Small Business Owners. We went over a few introduction questions, the 4 ethics of bookkeeping, and of course, the 10 accounting principles. Next episode, we'll actually start learning how to do bookkeeping, focusing on transactions and the accounting equation. If you have anything on your mind or you have any questions, please leave a comment. If you're interested in getting your bookkeeping taken care of, please visit vitalitybookkeeping.net. Otherwise, thank you for watching, and I'll see you in episode 2.